Welcome back, everybody. It is Tuesday evening. So here we are with Vetted VA Live, where we get together every week with three of our distinguished moderators in the Vetted VA forums. Tonight, we are going to be talking about a topic that really is on the mortgage side. So we don't have any real estate experts with us tonight. I've got two and soon to be hopefully three mortgage experts, and we're going to be talking about VA manual underwrites, the ability when we don't have an automated approval to go to the manual underwriting system and still get you into a home. So with me tonight, I've got Adam Baumlein here. And Adam, we just talked about it, Dublin, Ohio, an MLO in Dublin, Ohio.
Yep.
Perfect. And I've got JD with me here in California. So, and Vic will be on here shortly in Colorado Springs, Colorado. So with that, we always want to remind you guys, the most important thing about the show this week is we are here to answer your questions live. It's great that you can go to the forum and type in questions and get instant typed answers from the squad on duty and all of the moderators there. But if you want a longer answer, if you want to see someone smiling at you while they're giving you the response and what the answer is to your question, we're here. So if you have some questions, throw it into the chat over there and we will get to them as quickly as we can. But again, tonight we're going to be talking about manual underwriting, what that means, when you need it, and how it can benefit you. So with that, sort of to give everyone watching at home a frame of reference, let's start by talking about what is an automated approval, what are the benefits of an automated approval, and then we can transition into why you may not get it and what we have to do with the manual underwrite. Adam, you want to walk us through that?
Yeah, so really every lender is going to default to using an automated underwriting system, which basically is just a computer system that looks at all of your data, reads your credit report, and gives a decision based upon what it's looking at as to, whether or not the computer would automatically approve you for the loan. And so for a VA loan, you can get two answers. You can get an answer that's accept eligible, which means, or approve eligible, which means that the computer has automatically approved you for the loan, or it can be a refer eligible, which just means it needs to be referred to the underwriter for review. So, it's a computer system, maybe it's something that the computer cannot make a decision on. And so it gets referred to an underwriter. So
what are the benefits of the automated underwrite? Why do most loans go that route? Why do lenders prefer that we have the automated approval? JD, you want to give us some insights into that?
Sure, absolutely. So automated approval is a more streamlined process. You're still going to get an underwriter to verify that the data that was entered is actually correct and factual. But because they are able to go through data and compare it to multiple files and backdata and everything like that, it gives you a solid idea of whether it's a acceptable risk or not. And so it saves a lot of time and effort on the lender side, and that's why they want to default to that.
And you said something really important there. The automated underwriting system on the front end really is garbage in, garbage out. So we're all originators. We meet with consumers. We take applications from veterans, non-veterans. We can put anything in there. We could say you make $1 million a year. We could say you got $1 billion in the bank. And the automated underwriting system is going to read that and go, cool, approved. And that is oftentimes going to go with your pre-approval package, with your pre-approval letter. And the listing agent is going to look at it and go, oh, awesome. These guys are really well qualified. But if the data doesn't back it up, that is only as good as the input. So from our end, what we're really talking about is when it gets to the underwriter. So from us, it's probably a little bit inside baseball for those of you watching at home, but when you meet with one of us, we take your application, we gather a bunch of documentation, but before it gets to the underwriter, there's a loan processor involved. They're going to validate, verify, clean up that file further, and the underwriter is going to look at it and recalculate the income, look at the bank balances, clean that up and make sure there is no garbage in, that it is an honest, accurate input, and then they're going to run it. So for tonight, we are really talking about when we know we have all of the data, all the documentation, the underwriter is calculating everything, and they're running it through. what happens if you don't get that automated approval. So Adam, why don't you walk through that? Say I'm your borrower. I've come in and we took my application and you cannot get an automated approval. What are some of the reasons that you guys see? Either one of you, what do you guys see when a borrower is not getting that automated approval?
It could be a multitude of reasons, actually. So you have to think that the automated system is not only just looking at your credit or just looking at your income or just looking at your assets. It's looking at the whole picture, right? And it's reading your credit report. And so sometimes we as originators might say, oh, you know what? Yeah, this looks like it's going to be okay. And you run it through the system and it doesn't give you an approval. That doesn't mean that the loan is not doable. And this, I tell people this all the time. It doesn't mean it's not an approvable loan. It just means there's something there that the computer cannot make a decision on, and there needs to be a human element involved, right? And that's okay. Maybe the score is a little bit lower, and they don't have as much assets, or maybe the debt to income ratio is higher. Maybe the residual income is incorrect. That's a big piece on the VA loan that we look at, of course. You got to look at all those things. So those are some things that can come into play, where we have to then look a little bit deeper and see, what exactly is happening, or, what is within that loan that we think is maybe a do that, and then we go guidelines for that.
So you talked about a couple things. Probably the most common one, would you guys say, is credit? It's probably the one that we see the most, where we have a lower credit score, maybe a high debt to income ratio because of a large amount of debt, but it's probably the most common thing that we see, but far from the only issue. Now, there are actually a couple of situations that require a manual downgrade, even if you had the automated approval. I had probably the last manual underwrite I have had was almost 2 years ago. It was when rates were really low. Borrower came in, wanted to refinance, and one borrower was a veteran. Non-spouse borrower was not a veteran. So when you have two borrowers and one of them is not a veteran, doesn't matter if we get the automated approval. That's not even an option. It has to go for a manual underwrite, and that actually goes to VA for prior approval. So that's a special kind of manual underwrite. I'm not thinking of any right off the top of my head, but can you guys think of any other reasons that are just automatic manual downgrades where you would have to have a manual underwrite?
One of them would be if the borrower is receiving VA pension income. So not disability compensation, just VA pension. That's one of the cases where the VA automatically has to review the file as well.
So perfect. Now, when we're looking, we have a file, we have a borrower. Again, use me hypothetically, we don't have that automated approval. What are some of the differences of how we're going to work through that loan? Do I still get to use the same qualifying ratios? Everything from that end look the same? Vic, do we have audio now, or are we good with our?
Yeah, I think I'm on. Can you hear me?
I can hear you. We can hear you good from this end. So
yeah, so when you do the automated approval, the VA really doesn't have any kind of ratio. They kind of look at the whole picture. Some people here have probably had approvals in the 60s. I've seen them in the 70s percent ratio. Why would you approve a loan? A loan at 70%? Well, probably there's something else going on there. Us as loan officers, we're looking at, hey, is there other income here? They have a spouse that's also working. They have a business that is producing income. That 70% is not really going to hurt them. It's really 30% of their income, but it's 70% of their qualifying. But the VA doesn't have a ratio for an automated approval. When you go to a manual underwrite, now those ratios come into play. 41%, 45%, different numbers there. But the ratios have to be a lot lower for a manual underwrite.
So in a perfect world, a borrower really does want to get that automated approval. It makes it a little bit easier and a little bit more streamlined for you guys in terms of the documentation, but also allows us to go to a higher debt to income ratio. With that, there are some other changes there that come into effect when we're looking at a manual underwrite. So assuming we've got a credit issue and it's kicking it, and we have to look more closely at the file. How is an underwriter looking at credit differently for a manual underwrite versus that automated approval?
Well, they look for a couple different things. One, they're going to want to see a housing history, right? So now you're going to have, if you're renting, if you get an automated approval, then you're not necessarily going to have to get, in most cases, a verification of rent. When you go to the manual, now say, okay, we got to take a couple extra steps here, right? We got to make sure that things are squared away. So they're going to want to look at a 24-month history for housing now. They're also going to look at late payments and any derogatory collections, charge-offs, things like that. And it's going to vary a little bit between the lender, but at least for the first year, sometimes 24 months, depending on the lender, they want to see what's going on, right? Or is there a consistency of derogatory credit? Is it a one-time, isolated event? Might be multiple lates, but it's isolated at one point in time. Something happened. Have they moved past it? That's what the underwriter is looking for. When they see a consistency of late payments, that doesn't bode well for an approval, because you haven't shown over a period of time and multiple accounts that you're able to effectively make your payment on time. So they are looking for multiple different things in terms of derogatory credit in that regard.
Why don't we go a little bit deeper on that? So again, if you get the automated approval, and it could be a lower credit score, it could be a 610, 620 credit score, we get an automated approval. For the most part, it's overlooking everything in that credit because the automated system has looked at the credit, analyzed it, said, I'm cool with that. So you brought up a couple of really important points there. Probably 95% of the time, we don't have to verify your rental history. So you could have lived at home and had no rent and be going to a $4,000 monthly payment. They don't have a problem with that. On a manual underwrite, that level of payment shock may be a problem. So they're looking payment shock. They're looking at payment history. And for some people, that's an issue. Maybe you're renting from a family member and you give them cash and it's hard to document. So these are the things that your loan professional is going to be going through with you to say, hey, most files that go automated, we don't have that issue, but with this, we actually do. Does an underwriter, and again, like most times we can have a few late payments if we have that automated approval and we don't have to explain it. Is an underwriter going to make you explain all of those things? Adam, you were asking specifically saying, what happened? Why did it happen? Is it likely to recur? Do we really have to go through that process on a manual underwrite and put that in writing and explain, make a solid case for the borrower?
Yes, absolutely. If I may add, the VA specifically, when you look at the guidelines, they want to make sure that after you've been through a period of hardship, that you've reestablished your credit worthiness. And what that means is that you've consistently made on-time payments for a period of 12 months at the minimum. And so personally, the first thing I do is whenever I analyze a file for manual underwrite is determine if there have been any late payments in the last 12 months. And even then, that doesn't mean that you can't be approved. It will depend on what the reason is. So I'll give you an example. A soldier is PCSing from one place to the next, and they have to use their government travel card. For some reason, the DTS system is not working or the command can't get it paid on time. It shows up as a late. I've actually had a case where with a letter of explanation from the command, the underwriter was able to just completely disregard that late payment or those late payments on the travel card because it wasn't the service member's fault.
And it's an important distinction that the VA does always try to see if there's a way to interpret something in the veteran's favor. So you and your mortgage professional need to be working. I'm not saying go and make up a story as to why this happened, but there's sort of the boring, mundane, hey, I just boned it and didn't make the payment. And then there's the better explanation as to what happened, whatever those extenuating circumstances were. So that's something that we as originators are working with borrowers to paint that in the most positive light. I like to tell borrowers, I'm an editor. you wrote your story before you ever came to me. My job is to edit that story so that when the underwriter picks up that file, that it tells the story that we want it to. And that story is, this meets the guidelines. This is an acceptable risk, and I am going to make my payments on time. So that's really what we look at there. You know, one thing that I always like to talk to borrowers about, and we have the ability to do the manual underwrite. We have the ability to go to lower credit scores. And a lot of times, especially in the age of YouTube videos, bloggers, the clickbait headlines are always, hey, no minimum credit score, or I can do a manual underwrite, or Vic, you were talking earlier about really high debt to income ratios. In this instance, when we have a manual underwrite, if you can get someone approved, and let's say they have a 595 credit score, what are some of the downsides of that? Your thoughts, Vic, in terms of someone comes to you, hey, I can get you approved, but what is the cost of not being able to get that automated approval, or not having, say, a 640 credit score?
Yeah, there's several costs. Some of them pure financial, others just in the amount of work that's going to take. Let's talk about the second one first. It's going to take a lot more work to get a manual underwrite done because you have to go back and verify all the stuff that's been done automated. Adam talked about the 12-month mortgage history. You might have to do payment shock. You might have to create a budget to show, hey, this is what I'm spending now. This is my budget when I have this house. I've seen some crazy things, including a separate line item for Jersey Boy on hair care products. So there's a lot more work that you have to do to document everything, and that might be frustrating. So when I talk to someone I'm going to do a manual underwrite with, I'm like, hey, I'm willing to do the work on my end. This is going to require a lot of work on your end too, because I'm going to come to you with a lot of stuff that you may not understand on why it is. I'll try to explain why we're doing that, but pretty much everything that was automated is now manual. The other thing is the cost. A lot of lenders, most lenders will put in a loan level pricing adjustment for manual underwrite. So the loan itself will probably be more expensive than if you just have an automated approval. Not in all cases, but in many cases, a manual underwrite is a more expensive loan.
And not all lenders will do manual underwrite either, right? That's
true. Yeah,
that's a big.
They take a lot more work.
Yeah.
Well, not only that,
some lenders just. I'm going to say some lenders just have a flow where boom, boom, boom. They have a process where they just can push a lot of loans through quickly, and you throw a manual in there, and that really clogs up their system because it probably takes 4 times as much work as an automated approval, and they just don't do them then. The ones that do them will charge extra because it takes a lot more underwriter time to manual underwrite a file.
I'm sure you guys have seen the numbers. I saw it in relation to FHA loans, but credit scores below 620, the number of touches to a file are not like 4 times. They're like 10x what it is for a 700 credit score borrower. So that's one of the reasons why a lot of lenders won't do them. We've been talking here for 20 minutes, and a lot of what we're talking about is the additional work, both for you, the borrower, for us, for the processor, for the underwriter. There's additional documentation that goes into that, and a lot of lenders don't want to do it. The other one I'm sure you guys have seen, a lot of veterans will reach out to either one of the big call centers, and most of the time they don't get told that, hey, we don't do manual underwrites, or we can't approve you. They tell you you don't qualify. So it's one of the benefits. There is no one right channel for borrowers, whether that be going to a bank, going to a broker, credit union, one of the big box lenders. But one of the benefits for us as a broker, you guys were talking, I mean, what would you say? Probably 40, 50% of our lenders will do manual underwrites on VA loans. It's got to be close to half just won't even do it because of this extra level of work.
Yeah. And if you're getting the documentation up front, so I feel like a lot of this has to do with your loan originator, regardless of channel. If they're going to do a manual underwrite, are they asking for a lot of this documentation up front for the pre-approval to look at it, or are they not? Are they only asking for W-2s and and an LES and a driver's license and saying, oh, hey, it's gonna be fine? Well, there is a lot more documentation, as Vic alluded to. If you're getting that up front, it's a substantial difference in, number one, the amount of underwriting touches, but the customer service experience. You, like we talked about, you already have to do extra work. That's okay, but you want to try and limit that, right, and still make it as smooth as you can. And if the originator knows what to ask for up front, I feel like that makes a huge difference in the experience for the borrower.
I think it's much better for the borrower to get a list of, hey, these are the 30 items I need, 12 of them are, bank statements and all this other stuff, to give them, the one list and to go back to them 12 times and I get more because after 3-4 times, it starts getting, it starts coming on your competence. It's like, why didn't you know that I needed that before? And, it's just one thing, oh, one more thing. Those are the worst words a borrower can hear. So, that's my goal, my personal goal. Don't make it all the time. Is no more of these. Say one last thing. Just one time in the loan process.
Well, it limits that quote unquote hamster wheel, right? Like if you're not asking for those things up front, then you submit something else in. Now that opens another door, and then now you got to address that, and then maybe that opens another door. So that the more you get up front, and honestly, it's no different than on an approved eligible file. The more documentation you have submitted to the underwriter initially, you're getting a much cleaner review and you're getting a much cleaner condition sheet on what you need. And it helps to limit that back and back and back. Now, even within that, all of us, I think, can agree that we'll do our best to get everything. And sometimes something just comes up that, we don't know about. And that's just kind of the nature of the manual underwrite,
And it's funny. As originators, we have a certain skill set. Communicating with borrowers, we have to be able to know the guidelines, analyze that documentation. But I don't know about you guys, but I will acknowledge that both my processors and underwriters, they just have a different skill set. Their eyes are even more detailed, more hawk-eyed. We don't get to just, overlook stuff and say, well, give me a couple things, let me throw it together and send it on. But really, processors, underwriters are going through bank statements line by line, looking for deductions on every last pay stub, matching up dates on everything. And that's where a lot of this comes into play. There's more than just us in the transaction, but the better job that your originator can do on the front end of knowing what to get, asking you for it, and making it as easy as possible, the better off we're all going to be. One of the things I will say, I got into the business in late 1995. We didn't have automated underwriting at all until about 1997. So everything was manual and our files were literally like this big. You had to the double ACO things in a big giant manila folder and
have a stack order.
Stacking order, a printed stacking order, and someone would check it off and sign dates and all that fun stuff. And the benefit of that is that was underwriting. It wasn't a manual underwrite. That was just underwriting back in the day. And what I will say is around 97, we got automated underwriting. And I remember underwriters laughing, saying, well, that's stupid. They can never replace us. And that was sort of the worry or the concern, is that you could take the underwriter out of the equation, but we don't get to do that because they're the one that's validating that everything that we have in the file is accurate there. And bigger picture, what I was going to say with that, it made a generation of less detailed originators because that automated underwriting system is largely a cheat sheet. Put in the information, it's going to say, get this, this, and this. So it's hard to overlook things, or much harder to overlook things than it is on a manual underwrite. We actually have a couple of questions here. So why don't we jump into these and see what we can do about answering them? Sean has a beautiful fish there in his profile. I like that. With looking at bank accounts, if you have 2 or 3 different bank accounts, would you only need to submit the one your paycheck goes into? So, gentlemen, we get a borrower that submits to you 2, 3, 4 different bank accounts. Do you need to use them all? Do you always use them all? Is there a time when you would only use one, or is there a time when you would want all of them?
I don't want to see all of them. I want to see the ones. I want to see the one that you're going to use. So it's not just the one that your paycheck's going into, it's the one that your earnest money is coming out of, and it's the one where your funds are coming out of. Now, if you're going to be using all 3 bank accounts spread, and you're going to be consolidating into one, yes, I need to see all of them. Not just that, I need 2-month statements for each one of those as well, up to 2-month statements. And then we also have to source those transfers. So it's best just to have one bank account. And other people always give me a retirement account, TSP accounts. I just delete those out. Really don't need those unless you're looking for reserves, which on a on a file they're trying to get approved on. You might need that, but for the most part, you don't need reserves on a VA loan, on a 1 unit VA loan.
I'll see.
Well,
I see a pretty consistent. If they're getting like VA disability or something, they'll use USAA as their account, right? It's very low balance. They're just kind of getting their automated deposits in there, and then wherever they live in the country, they're banking locally. So it depends on where's your money coming into? Is it going into multiple banks? Are you the person that has a little bit of money everywhere at all these banks? I think as originators, we try and make it as easy as we can. So like Vic said, if we don't need it, we're not going to submit it because there's just potential that they're going to ask more questions.
Mm-hmm.
And so if you don't need it to be approved, ideally we probably wouldn't submit it.
We don't even necessarily need to see the paycheck going into the account. Sometimes if you're getting Social Security or disability, they may want to see that that's hitting the account, but generally not for paychecks. So if you could limit what you're showing, that's great. Really, the other thing, some people budget like the Dave Ramsey method or something, where I shouldn't say that, but where they have 12 different accounts for everything, and the money's going in between, and they all have an average balance of $10 in them. But once again, just kind of narrow it down to the account that you're going to use, and try to, before you get into it, when you're going to buy a house, try to get your earnest money and any money that you can use for closing costs. You don't need down payment because you're doing a VA loan. Well, in most cases, you don't need a down payment. Try to get it into as few accounts as you can, because it's going to be less painful for you as well as your loan officer.
1,000%. I have a file, or had a file we closed 10 days or so ago. Borrower had 5 bank accounts, 2 different institutions, and he actually wanted to buy about 2 years ago. Market was crazy. They kept getting outbid on everything because he wanted to come in $5,000 under list price. So he wasn't planning on buying. So of course he gets it under contract, doesn't say a word, and starts moving the money from one account to another, and then consolidating it finally into the one. And we had a heck of a time. And finally, my underwriter and I just said, hey, I gotta come clean. I got to tell you everything here, and you tell me how we can unwind this. He has plenty of money. The borrower was actually putting 50% down on the property. So it was a lot of money moving around among all those counts. So long way of saying, hopefully you have a longer lead time in your process. You talk to a loan officer early and you can have this conversation. It's a very important conversation to have if you have multiple accounts, because, Vic saying, hey, I really only want to have one account. Hopefully you're using that primarily, but we just came up with 3-4 different reasons why you may need all of those accounts. So hopefully it's not a last minute thing that comes together. You can go through it up front with your loan officer and you come up with a plan of what money are we using, where does it come from? How long has it been in there? Vic, you said something there in the context. It wasn't necessarily relevant to this question, but it certainly is to our topic tonight in talking about manual underwriting. So 99 times out of 100 on a VA loan, we're not going to need reserves. In a manual underwrite, is that a situation where having post-closing reserves, more money left in your bank account after we close, is that something that can be beneficial in a manual underwriting situation?
Absolutely. I mean, it's one of the not mitigating factors.
Compensating factors.
I'm having a mind slip there. I'm getting old. I'm going to put on that. Yeah, compensating factors. That's absolutely a compensating factor. If you have not just money in the bank account, if you have a TSP, retirement account, a 401k, something that you're not going to tap into, but you got $20,000 sitting in there. $10,000, that's absolutely a compensating factor, because what that tells the underwriter is, hey, if something happened, this guy had, or this person had credit problems in the past, they weren't able to pay their bills, but if push came to shove, they could take out a 401k loan, cash out the 401k. They have reserves there to make it work, so that they don't go into foreclosure, and so that absolutely will help the strength of the file, along with other compensating factors.
So let's talk about that. What a compensating factor. We didn't get an automated approval. The compensating factor is something that allows us to say, hey, we don't exactly meet the guidelines, or at least the guidelines as the automated underwriting system wants to see it, but these are good things in our favor is essentially what compensating factors are. Additional things that lead an underwriter to believe that you'll be able to successfully become a homeowner and make those payments on time. What are some of the other things besides having excess reserves after closing that we can show an underwriter as compensating factors?
One of the biggest ones or easiest ones to get is 120% of the minimum residual income as a compensating factor. Another one I can think about would be if your new mortgage payment will be less than what your current rental payment is. There's a few times where I've seen that happen. If you already are supporting a higher payment and you're basically going to be lowering your payment, that's a compensating factor that they can use as well.
Yeah. I had a traveling nurse where they were getting some pay that wasn't be able to use as effective income for the qualification purposes of the loan, but it could be used as a compensating factor because the underwriter saw all of the income documentation and knew that in this person's case, like literally it was about half their income. So the way that the file looked in terms of the debt to income ratio for qualification purposes, the true life scenario was things are much better than what they look. And so that was able to be used as a compensating factor, which is good.
And for a lot of vets out there that are getting VA educational benefits, that's another compensating factor. So I just closed a joint loan this month where it did require a prior approval, and that was a compensating factor. That even though the vet didn't have a huge amount of income, he was getting his housing paid for by his educational benefits, and he was in a line of work. A program where he's going to be working in about 6 months. He'll have a job, and that'll easily be replaced. And so that was definitely a strong factor, compensating factor in his loan approval.
And there's a few others here. If you're refinancing and you have a bunch of equity in your property, maybe you don't have the greatest credit. We're paying off some debts, but you have a nice amount of equity in the property. Again, really what the underwriter is looking for is just strengths in the file that makes it maybe okay that we're not just perfectly towing the line in all of the other regards. With that, Vic, you had just mentioned that you had a recent file. Any of you, Adam, JD, have you had a recent manual underwrite story that you kind of want to walk through and talk us through what a typical manual underwrite file might look like?
I've had a couple recently. There was some credit challenges in the past, and over the past 12, 24 months, everything was fine. The credit scores hadn't rebounded yet. I think a lot of times what a lot of us will see is if someone gets into a bad credit scenario, they default to not using any new credit, right? And so they don't have a lot of credit to reestablish themselves and it just takes longer for the score to come up. And so the system, is going to give them a manual underwrite. Again, doesn't mean they don't qualify, doesn't mean it's a bad borrower. It just means the system didn't have the ability to give the approval. So I've had a couple of those in the past couple months that we get done, no problem. And it was, again, just you get that documentation up front, and things go relatively smoothly. So
what kind of credit scores were you seeing with those borrowers? We talk about not really having a credit score requirement, but those borrowers were unable to get an automated approval largely due to credit. What kind of credit scores did they have?
Those were actually below 580.
Okay.
So, yeah.
Now, interesting enough here, I just had one where the borrower had a 674 credit score. And I had on his pre-approval, I'd had a approve eligible, but he's buying a manufactured home. Rate was a little higher, and it's a manufactured home, and it went in refer, which means it's a manual underwrite. He was getting a manual underwrite. I mean, I really worked that one pretty hard because trying to figure out why it did that. And what the conclusion that I came to with talking to various people was he only had 3 trade lines. He was a young kid. He was only 21 years old. Didn't have any very depth. He had no derogatories. He had a decent credit score, 674, very little debt. He had a car payment and 1 credit card with a couple $100 on it. Yet it still went refer. So it's the depth right there. So it's not necessarily always just the credit score. It can also be the depth of credit.
And that's a good detail I wanted to bring up is the models that they use, the risk models that they use for automated underwriting are constantly changing. So you might have an update that you have the borrower last week, everything was working fine, and today it's not working. Well, the manual underwrite allows you to look at the big picture, to have a human look at the file and say, no, you know what, this is actually this is a risk we're willing to take, so we'll lend them the money. And for some reason these days, I don't know if it's because of the market, more and more lenders are willing to do manual underwrites. And in addition to that, they're willing to increase the DTI on manual underwrites, where before there was a hard cap at 50%. Now, most of them now I've noticed are at 55 and some up to 60, 65% with compensating factors.
That, and with that, when you get really high, 55, 60, 65, the lenders that you're seeing, have you seen how many compensating factors they want? Normally it's more than just one when you get to the higher debt to income ratios like that, correct?
Talking 2 to 3 sometimes. So if you're talking about a cash out refinance, it's easy to get compensating factors like that, where because you're paying off so much consumer debt. So let's say you had a car loan, you had a personal loan, pay off the credit cards. At the end of the day, I've had a case where even though the mortgage interest rate was higher than what they had beforehand, they're ending up paying less per month in debt payments than their situation was before. And so that was a big compensating factor for them.
100%. You know, while Vic, you brought up an important point, and then JD, you kind of followed up on it. The model is not only always changing, it's a complete black box to us. So one of the most frustrating things that we can have an experience is have a borrower that we have an approval, and then they find a property and we go run it, and we no longer have this automated approval. And a lot of times you don't necessarily know why. You know, Vic, in your situation, switching to a manufactured home, higher rate, higher debt to income ratio, you have a couple of changes that would probably surmise that's what it was. Sometimes you don't even know. You're like, I don't know this. I mean, every time I've run one like this before, I mean, we'll see, we're all in vetted VA groups, private groups of the vetted VA pros, but also other loan officer groups. You'll see someone posting saying, has anyone seen this? Any idea what's changed? And sometimes it is as simple as a change in the model, that what was okay last week is not okay this week. But it's a little bit frustrating, and it's not always easy for us to pinpoint, because the guidelines are always the same. The VA handbook, we can look at it and see what it says, but how they're implemented in terms of the automated underwriting is constantly changing and evolving. Sometimes in relation to things, loans went bad for whatever reason, the market has changed and it's not going to be as aggressive as what it was. But it's an interesting thing for us on the professional side. I kind of wanted to circle back. JD, you talked about something that was really important. Probably the biggest compensating factor, or the biggest thing that the VA relies on in terms of approving people, is having excess residual income. Would you guys agree that's probably their favorite thing to see? And it's a unique thing to the VA loan program, because almost no other program calculates residual income. And it's one of the reasons why the VA loan program has been so successful with very low default rates, despite going to high debt to income ratios. Adam, you want to maybe go into a little bit more depth on what the residual income calculation is and how that varies? Because it is a little bit different in terms of both what income we credit people with and what debts we have to hit them against for calculating that residual income.
Yeah. So, and actually we had some questions on this today within vetted VA. So number one, when it's taxable income, you're looking at the gross income, right? Not what you take home, what it is before taxes. So if your W-2 income for your gross income is $60,000 for the year, that's $5,000 a month. You're not bringing home $5,000 a month, but you're getting credit for the $5,000 a month. Well, when you're calculating residual income, they need to look at those taxes and all those, whatever those deductions are, that factors into your residual income. If it's non-taxable income, of course, there's no taxes coming out of there. For the qualification purposes of the loan, we can actually gross that income up. But at the same time, you have to then take that increase and use it as a deduction for the residual income calculation. There's a maintenance and utilities calculation. So the size of the home, right? So if it's a bigger home, it's going to cost you more per month to be able to heat, cool, and, keep that property. So you have to calculate 14 cents a square foot there. Amongst some other things, and that residual income, and I can actually give you a perfect example. I just closed this loan. I had a borrower who was trying to purchase, and we're trying to get a debt letter for this debt that we couldn't get. And when I ran it through the automated system, same income, same everything, but my residual income was now under 120%. I got a refer eligible. My DTI was too high to be approved for that. Well, he had a very small car payment and very little bit left on it that we actually paid off at closing. And that moved his residual income back above 120%. And now the loan became approved eligible and be able to close. So there's a lot that goes into that, and it can be right on that line, and it can be $1 over, and you might get an approval versus not getting an automated approval.
I don't know about you guys, but one of the things that shocks me the most of things that I see other loan officers doing, rookie loan officers or loan officers just aren't experienced with the VA program. We probably all do cross qualifications. Maybe at other parts of the country, they're not as big a deal as they are here in California, but our realtors always want us to go back and look at that pre-approval and see if someone really does qualify. Well, most loans don't have that residual income calculation. Most of the pieces of software that we as loan officers use don't automatically calculate that residual income. And when it runs it through DU, it will usually come back. DU is the automated underwriting system. It will come back with a monstrous residual income number. And a lot of times you'll see these approvals and it'll say this person has $2,000 a month residual income. And you're like, there's no way they have $2,000 a month residual income. So if you have a loan officer that is unaware of this calculation, doesn't know how to do the calculation, doesn't know where to input it into the software, that is a full-blown garbage in, garbage out situation. And I see it, I wouldn't say all the time, but we see it fairly regularly. And it's a really, really important one to get right, to know that we have the automated approval. And if we don't have the automated approval, that we have a really solid compensating factor when we're going and doing that manual underwrite.
One of the first things I mentioned, actually, it's like pulling the COE right away, got to do that. Next thing is, you got residual income is probably really the driving factor on the VA loan. And so calculating that is, in my mind, is probably the most important piece, because that's going to determine really what you can and can't do. And it's the only loan type that has that. It can definitely work to the veteran's benefit for sure. But you're right. If they're not calculating it, it's not done correctly, they're getting an incorrect answer, and you're not being given a proper, review.
Well, this is funny. You just mentioned, you followed up on what I said, and you mentioned something else that we talk here regularly. You don't have to use a vetted pro, but you better be using someone who's experienced with the VA program. And one of the things that people always ask, well, how can I tell? Do I just ask them how many VA loans you've done? Well, there's not really a way for the consumer to validate that, but two things that you just mentioned that make it pretty easy. Once you have your pre-approval done, say, can I get a copy of my certificate of eligibility? Hopefully they don't stutter and stammer and say, oh, I don't have one yet. You would be shocked at how many times they don't. There's a good one. And you say, can you walk me through my residual income calculation? I want to know how much I have, because realistically, I would bet you 70-80% of loan officers out there are doing VA approvals without doing that residual income calculation. And if you have a really well-qualified borrower, that's probably a safe thing to do. Not a smart thing to do, but probably safe. But, with rates higher, with prices higher, I think most of us are dealing with higher debt to income ratios, and that residual income is an important thing. So it's almost, if you're watching at home and you're a veteran, that's kind of a cheat sheet for knowing, does my loan officer understand the VA program, and are they on top of it? Did they calculate my residual income? Did they pull my certificate of eligibility? And then from there, interview them and trust your gut. And you should be able to determine whether you're working with a pro like the three gentlemen I have with me here tonight. We've been talking for about 45 minutes. I think we've done a pretty good job of going through the manual underwrite. But before we wrap it up, I'd love to give each of you an opportunity to go through anything manual underwrite related, general VA related, just any words of wisdom you have for those of us, those watching us at home tonight. Adam, anything you want to wrap us up with?
Yeah. So I was just sitting here thinking, I'm glad you said that. So a big one, when you're filling out the application, your dependents and their ages are important because of childcare, and that factors into residual income. Or if you're paying an alimony or child support, that those are not listed typically on your credit report, that the loan originator is not going to know about. And those are typically a larger expense. That can dramatically affect whether or not you're approved or how your approval is coming through, whether it's an automated approval or whether it's a manual approval. Very important to note. So if your originator hasn't asked you about that when they're reviewing your application, or had you fill out a child care statement up front, that's a big sign of something you want to look for.
Yeah, and kind of throw on that child care statement, that causes some confusion. It's not a child support or anything like that. Child care is just how much it costs you for kids under 12 for their after day care. It doesn't go in your DTI calculations, but it does go in your residual calculations. And so that will, whatever you put on there, that's going to come off your residual. So if it's costing you $600 a month, that's going to be $600 a month less residual that you have. But it's not going to really affect your DTI. So that's a big one. People always have a question about the child care statement. Kind of clarify on that one. We talked about compensating factors before, but did you guys want to just go kind of through those really quick, kind of so everybody that's watching knows what those are?
Sure. If you have the list, roll through it, Vic.
Yeah, I have the list. I pulled it up here. So, these are things that will help you with your manual underwrite. Excellent credit history. Obviously, that one makes sense. You just conservative use of that credit, minimal consumer debt. If you have long-term employment, that's a definitely compensating factor. A lot of liquid assets, a lot of reserves. If you have a down payment, that helps. Exists equity in a refinance loan. Little or no increase in shelter expenses on a refi or on a new purchase. If you have military benefits that aren't being counted, like you're getting a hazard pay or flight pay, things we can't always count. If you've had satisfactory home ownership in the past, high residual income, low debt to income ratio, tax benefits for childcare or for home ownership. Those are the kind of things we look at for compensating factors without trying to drag this out too much farther. But we've been talking about them. I just thought it was important that we actually kind of put out what those are.
No, it's funny. I'm in a unique position here. I do loans every day, but then I get to be here every Tuesday. And here we just beat up a topic all the way through it. And I will tell everyone, my job is not rocket science. You don't have to have a 200 IQ to do loans. But then I hear you guys talk about this stuff. You're going to go, it really is complex. The number of things that you have to keep an eye on and be detailed. And I was joking earlier that we don't necessarily have the hawk eyes like an underwriter does, but you got to be pretty close to an underwriter, or these things will jump up and bite you, and you'll upset a potential homeowner, upset a realtor partner that's referring business to you. It's just very complex. It's not rocket science, but there's a lot of complexity, a lot of nuance in all of this fun stuff. So with that, JD, you want to have the final words of wisdom for the night?
Well, I appreciate that. One thing I want to stress is do not self-disqualify yourself. Do not self-diagnose yourself. You might have Credit Karma or use MyFICO and you think your score is too low. Well, you know what? Until you have a professional look at your credit report, that really doesn't mean anything. I'll give you an example. I saw a credit report last week for somebody. Score was in the 400s. All right, we can still make that work. I went through it with him, and apparently
you're a tough man. It is hard to accomplish a 4-something credit score. I've seen them before, but it's not easy.
Well, listen, here's the thing though. Most of their accounts were paid on time, and there was one that was showing mistakenly that he was not paying it on time, even though in reality he's making his on-time payments. So what happened was he reached out to that creditor, and they're getting that fixed. And once it's fixed, he should be able to buy a home.
Mm-hmm.
And so don't self-disqualify just because you see your score a certain way. Let somebody have a look at it and then determine from there.
Yeah, and kind of piling on top of that, JD, I see a lot of people on vetted VA. They're trying to do their own DTI calculations. I applaud you for doing that, but there's so many little rules, like you have student loans that don't have any payment because they're deferred and they're probably going to be waived later on. Those count, and you have to put those in there. But there's so many little oolies and factors that go into calculating DTI. And then on top of that, VA doesn't have a DTI limit or DTI cap for an automated approval. The best way to do this is actually just get with a mortgage professional, have them do the calculations for you instead of, and that relieves a lot of the angst, because people are, for whatever reason, they don't want to talk to a professional and they're trying to do that on their own. Hey, we do that, and we gladly do that for you. It doesn't cost you anything. Go ahead and get any professional engaged on it.
Yeah, you said something really important. There's not a cost for it. People always ask, well, is there an obligation? Well, if I'm cool to you and we do a good job and we have competitive terms, I would like to think that if you buy a home, you're going to work with us. But that's sort of the cost of doing business, right? We meet people, we do a good job for them, and we hope that they're going to be able to buy a home and we can close a loan for them. But there is no obligation. There's no contract. You're not signing anything. And like piggybacking off that idea, there's a lot of people that do the self-diagnosis, that try and go to YouTube, that go to Facebook, that do some research. And there only seems like two types of people. There's the type that look for like confirmation bias, that they want to hear that it's going to be okay. And it's absolutely not going to be okay, but they've read enough to say, no, I'm fine. I saw this YouTube video that says it's cool. Or the other side, that they are absolutely going to be okay. And they've convinced themselves, oh, I saw this one video that said I cannot do this and I'm not going to be eligible. So by all means, a lot of what we are doing in the current market, people will go back 2 years ago, we were order takers. Rates were incredibly low. Everyone could benefit from a refinance. It was answer the phone. How much money can we save you? Now, a lot of what we're doing today is, do you qualify? How can we get you there? How do we analyze your credit, get your credit score fixed as high as possible so we can get the automated approval? Or how do we get you approved with a manual underwrite? So again, if we leave you with one thing tonight, it's like Vic said, get with a mortgage pro that knows the VA program, that knows the ins and outs, and spend some time with them. There is no obligation. There is no cost. And what you will get out of that is the confidence of knowing I'm cool and I can do this today, or I've got a game plan that I've got 2 months, 6 months, 12 months of work so that I can get into a property. You wouldn't have reached out to them if you didn't want to become a homeowner. And it may not be possible today. It may be, it may not. But the only way you're going to get a game plan and know exactly what has to be accomplished is talking to someone like these three gentlemen tonight. So thank you guys. Thanks for spending the time sharing your wisdom. Hopefully, if you're watching, you'll be back next Tuesday again. The experts get to pick the topic every week. So it's sort of it's the opposite of dealer's choice. I show up and I get to hear what the experts want to talk about, and we go through it. So be back next week. If you have questions, whether you got them answered or it was a short form answer in the forums, we're here. It can go in as much detail as you like. So show up, throw some questions in the chat, and we look forward to seeing you next week. Thanks a lot, guys.
Thank you.
Thank you.